Thank you to Luca for that introduction. So we have only a few minutes left for our time. Luca promised you that I would share the results of our upcoming November election. So I'm sure that you're looking forward to that. So you heard the European portion of the presentation. What I have to say is quite unsettled, and that's Basel in the U.S. So as just explained, in the U.S., the proposals are far less advanced. So in July of 2023, the U.S. banking agencies, we have three, released for comment what we refer to as Basel Endgame. And there was an initial comment period of November of 2023 for proposals that were roughly about 1,600 pages long. The financial services community had a little bit of a meltdown, and the banking agencies extended the comment period to mid-January of 2024. So a brief extension, but not altogether that helpful. In the period since, there has been an extremely active lobbying and advocacy effort on the part of the financial institutions community in the United States against the rollout of the Basel proposals. So the Basel proposals would apply to a number of banks. So they would apply to banking organizations with total consolidated assets of 100 billion or more. So we divide or group our banks into categories. They would apply to the banks in categories as you see attached, and they would apply to our 8 U.S. Globally systemically important banks. They would also apply to a number of banks that are foreign banking organizations, as well as banks that have significant trading activity as to certain parts of the rule. And so here's a list of the banks that would be affected. Obviously, there would be a number of additional kind of effects that would apply to systemically. So if you think about how the systemic effects would be applicable, and that's something that has been emphasized in all of the lobbying and advocacy efforts, it really relates to how the calculations for regulatory capital purposes would change, and they would change pretty dramatically. So in the United States, banking organizations currently calculate the amount of regulatory capital that they hold by aggregating the adjusted accounting values of eligible capital instruments. And the proposal would require that the banks that are affected, so those that are 100 billion or more, would be required to include accumulated other comprehensive income in their calculations. And this would also, the proposals would change risk-weighted assets. So even you would look at this, which was referred to on the prior in the prior presentation, you would look at this dual requirement, and you would take the higher of the two calculations, the standardized approach, the expanded risk-based approach. You would determine the higher of the two. You would use the higher of the two. So you would look at a fairly significant increase in capital requirements. And when you look at that increase in capital requirements, then you think about the knock-on effects of that to the real economy. And that is what banks have been talking about in all of their advocacy efforts. That increase in capital requirements could, of course, be passed along to consumers. Banks could pass that along to consumers in the form of higher prices for banking services and banking products. They could discontinue certain products or services that they currently offer. We could see that in the form of reduced returns, in how banks have been providing returns to shareholders. So banks could cut their dividends. They could cut their repurchases of stocks. Those are just examples. We could as well see more mergers or consolidations of banking institutions in the United States. We've started to see some already, and we've started to see some banks, including particularly foreign banks like Canadian banks, take toehold stakes in U.S. banks like KeyBank, for example, which just got a strategic investment from Scotia a few weeks ago. You'll see more of that activity as this develops. And why? Because banks in the United States are already operating at optimal capital levels. So when you factor in the very high risk weights that these proposals would adopt, you get some very restrictive requirements here. And overall, you get negative impacts to the banking sector, negative impacts to US GDP, and overall higher risk weights. And in turn, obviously, a requirement to raise more capital on the bank's part. So in the prior presentation, there was already a reference to the fact that the proposal would create an expanded standardized approach that's based on the existing standardized approach that we have in the United States. So that results in a number of different things. It translates into a couple of things, and I'm going to go through these relatively quickly just because we have limited time. The slides are going to be with you, so you can refer to the slides. So if we look at what the proposal does, very detailed requirements for commercial real estate, maybe more importantly for this audience, very, very detailed requirements for residential real estate. So for residential real estate, and this is a very different approach than that taken by European regulators, it's very prescriptive. It purports to take into account risk. However, it purports to take into account risk by looking at the LTV of properties. So it assumes that higher LTV properties are riskier, and therefore they should have higher risk weights. It doesn't necessarily factor in other things for residential mortgage loans like FICO scores. So you could have a very high FICO score for a residential mortgage loan, but and generally that's a good indicator that that's a good mortgage loan, but that might get assigned a very high risk weight. So what is this going to mean for the mortgage market in the United States? Well, we in the United States have always put a very high premium on home ownership, and we have looked to the banks as being the prime lenders for our U.S. mortgage market. Should this come to pass in the way that it's been proposed and without any changes, that might change. A lot of the mortgage market may move out of the bank space to the non-bank space. Now, you might think, oh, she's crazy. She doesn't know what she's saying. But there is good evidence for the fact that this has happened before. After our Dodd-Frank Act, after the financial crisis, a lot of the mortgage market already moved from the regulated market, from banks to non-banks, as a result of over-regulation in the United States. So after the Dodd-Frank crisis, when our banking agencies were overreactive to the financial crisis and regulated activities that had no nexus to the financial crisis, what happened was that most of the mortgage servicing in the United States moved from banks to non-banks. So most of the servicing in the United States is now in non-banks. So the same could very well happen with residential mortgages. So we also see the elimination of non-significant equity exposures and more restrictive equity weights in the U.S. Basel Endgame proposal, changes to the off-balance sheet commitments, and a very punitive approach to securitizations. So there is an approach that adopts a form of the securitization framework, but it adopts it in a way that's quite different from the way in which it's proposed to be adopted in the EU. So there's an elimination of the advanced approaches for credit risk. Again, we see a fundamental review of the trading book and market risk capital requirements. So overall, this, again, is a very broad brush approach. So it restricts the use of internal models, as was previously mentioned, and subjects a number of transactions and a number of business lines to very different financial models. And for example, it reduces the capacity of U.S. banks to engage in certain activities. In particular, what kinds of activities that would affect this audience? Well, it affects capital markets activities. So it affects securities financing transactions, repo, margin, securities lending. It affects derivatives. In particular, it affects derivatives transactions through changes to the credit valuation adjustment methodology. In the EU, for example, the EU regulators have exempted transactions with non-financial counterparties from CVA adjustments. We don't do that in our U.S. transaction, in our U.S. implementation. In the EU, you exempt client-cleared derivatives. You also adopt a very long runway for your transition period, which the U.S. approach does not. We have this very bright line banking book, trading book boundary, which is very, very punitive. In the U.S., there's an operational risk capital requirement. This would be the first time for a lot of smaller banks, and $100 billion may not seem like smaller banks, but a lot of these banks in the United States are regionals or quasi-regional banks who would have to adopt operational risk capital requirements. So this would be a very big lift for a lot of banks in the United States. I talked a little bit about credit risk. The other issue, which has been a big focus of the advocacy efforts in the United States, is the long-term debt requirement. So this is like MREL in Europe. We have a long-term debt requirement already. This has been applicable for the U.S. G-SIBs. So this is, or TLAC, this is already applicable to G-SIBs. It would be pushed down. So aspects of this are very controversial. So there are two different elements to this proposal. One is an amendment to the existing requirement for G-SIBs, as well as a requirement that would be applicable to the new banks that would fall under it, and that is a minimum denomination requirement. So TLAC would not be able to be sold in denominations of less than 400,000. The idea here is that it should not be sold to retail. That's very problematic in the United States because a lot of bank debt is sold in $2,000 denominations, and it's sold to pension accounts and to insurance companies and retail. So that's very difficult. The other part of it is, I've already told you, banks are going to need to raise a lot of new funding. They're also expected to raise at least $70 billion by some estimates, $120 to $180 billion by other estimates, in long-term debt to satisfy the long-term debt requirement. If they can't sell to bond funds and pension funds that want small denominations, we have a significant issue. Part of the long-term debt requirement is a clean holding company requirement. And that is that the issuer of the long-term debt be a bank holding company. some of the banks that are subject to this, or that would become subject to this requirement in the United States, don't have a clean holding company. So, for example, our credit card banks, which would be newly subject to this requirement, would have a very short phase-in window for this. So, fairly substantial changes in the United States. As I said at the outset, it has been a pitched battle. You see TV commercials about this proposal. It's very odd in the middle of baseball games, in the middle of the World Series, in the middle between Trump ads, to see ads about Basel Endgame. And Middle America probably has no idea what on earth is going on. What is Basel Endgame? What's being talked about? They probably have even less idea about that than about the upcoming election. But bankers associations, the trade associations in the United States, Bank Policy Institute, SIFMA, the various trade organizations have decided that it's very important to bring to light the fact that these proposals have real world impacts on the real world economy. So were all of these to come to pass in the way in which they've been proposed, they would create a very unlevel playing field between the United States and Europe. They would disadvantage the United States and U.S. banks compared to their European peers. They would create a situation where international rules that are supposed to create harmonized regulatory requirements would be disharmonized, really, and not the same. And there would be regulatory arbitrage. There would be reduced services and products for Middle America. It would reduce small and medium term lending to small and medium term enterprises, and increase the borrowing costs for businesses in Middle America, and reduce the availability of credit and credit products like credit cards and mortgages. So what's the good side, or what's the upshot of all of this, if there could possibly be an upshot? Well, everything that I said today should be qualified by the fact that if you've been nodding off, falling asleep, none of it may matter at all. These terrible numbers, this study that PEWC and others have produced about the horrible, all these horrible things that may happen, all of this may be rendered completely moot. At 10 a.m. Eastern Time in Washington, D.C., at the Brookings Institute today, Michael Barr, the vice chair of the Fed, will be giving a speech outlining the re-proposal of these rules. Odd choice. And everything in the United States is odd right now. That's all we can say. We have no excuse for ourselves. Why would these rules get reproposed when we have an election in November? No good answers. The rules will get reproposed next week. So we will have another, 1,500 pages of stuff to read. Will most of what I told you today still stay? Yes. Are we expecting dramatic reproposals? No. Where are we expecting most of the reproposal activity to occur? We're expecting most of the reproposal activity to occur around the operational risk and the market risk. And it's going to be tinkering, not wholesale change. So did the TV ads work? No. Did Middle America come out in favor of the banks? Absolutely not. Middle America does not love their banks. Will we have to find a new solution for the mortgage and housing situation in the United States? Yes. Might that be good news for covered bonds in the United States? Maybe. I will finish with one glimmer of hope for covered bonds in the United States, and that is that when we met in our offices in New York in December, It was at the time that the FHFA, which is the oversight authority for the FHLB, among other entities, had just released its proposal for the FHLB at 100. The FHLB is now considering its role as it commemorates its 100 years, and a new role in the housing industry, and how, in light of all of this, it can have a role in housing and housing finance, particularly given housing shortages and inequality in access to home equity financing, and the fact that there will be less money for mortgages and less access to credit for homeowners. So, good thing, bad thing. Who knows? Thank you.